Just 3 years ago in Jackson Hole, Wyoming, you gave a speech where you were confident that inflation was transitory, which I think we've come to realize it's not the case. This hearing is sort of a can't-miss opportunity for the Fed to demonstrate some humility on the monetary policy decisions, which some on this side of the aisle particularly think have made inflation worse. Your August 2020 Jackson Hole speech, you said the flexible average inflation targeting framework regarding 2%, that you would let it run above 2%. Was the Fed blinded by the previous 20 years of global change that was deflationary and or you were not alert enough in 2020 to be more cautious about that change in policy?
So we were certainly mindful of a long period of time in which there have been very low interest rates, but also very low inflation, suggesting that the neutral interest rate must have fallen quite substantially. That was the standard view. The thing we didn't see coming was the pandemic. It's not like everything went off the rails. It's like we had this pandemic and it really changed the way the economy is working. We had a big crisis. We did a lot of things. So the concerns that led us to, those concerns that we were in a world of very low interest rates all the time.
But now wouldn't you say we're in a very opposite situation where because of reshoring and tariffs and other policies that are quite inflationary?
I would say this. Those concerns are, right now we have the policy rate in the mid-5s, right? And we see the policy is restrictive, but clearly interest rates, the neutral interest rate must have moved up, at least in the short term. So I think that's the question we'll be asking ourselves in our review, which begins at the end of this year.
We look forward to that.
How much of what we did in that time period is relevant to the new world where rates appear to be higher?